Welcome to another episode of Zerodha Educate. Debt markets have suddenly become more action-packed than the equity markets. Ever since the IL&FS default, investors have slowly grown to realize that even debt carries its own risks. While a lot of ink is spilled on spreading the message about the virtues of investing in equities, much isn't written about debt. But debt plays an important role in a portfolio. Today, we couldn't have honestly chosen anyone better to speak about the case for investing in debt. Today we have with us Mr. Arvind Chari, the head of fixed income and alternatives at Quantum Advisors. Arvind has over 14 years of experience in fixed income markets across dealing, research, and portfolio management. Arvind joined Quantum in 2004 as research analyst fixed income to build the fixed income and macroeconomy research function and to also help develop fixed income and other asset class products for Quantum Mutual Fund. He also helped set up an offshore India bond fund amongst the first of its kind then. Arvind holds a master's in commerce and a master's in management studies from Mumbai University. Arvind is also a really good writer, and you could check out some of his articles on money control and value research. We'll add links to the pieces that inspired us to ask Arvind to talk about the topic at hand today. Over to you, Arvind.
Hey, thank you for giving this opportunity. And you're very right in saying that debt funds and debt markets have been in the limelight more than equity and equity small cap, mid cap funds, especially in the last 6 months. And whenever I speak to retail investors, and Quantum does something called as a path to profit, where we go and directly meet retail investors, I off late, especially in the last 1 year, we've got quite a few occasions where people seem to be confused of what they've done or really have no idea that debt funds can also have risks. So this is another opportunity. As you said, we've written quite regularly and quite vividly about how to invest in debt funds, risks and opportunities. What should you do? So thanks for giving another opportunity on what you say, investor education. So to begin with, I'll just lay down five what we call tenets of investing in debt funds. So this is the basics. This is the thing that every investor should keep in mind before, while, and as they have invested in debt funds. So the first is very clearly, debt funds are not wealth generating products. Investors should not assume that if they invest in a debt fund, they will make 10, 11, 12, 13% returns. It does not happen in debt funds on a sustainable basis. And that's why it is wealth generation is done by equities. So if you want to create your corpus grow your corpus for retirement or child education or your own wealth creation, it cannot happen through debt funds. So that everybody should be very, very clear that when you're investing in a debt fund, keep your return expectations low. And the basic objective of having debt as an asset class in your overall allocation is essentially to have like an assured, safe return income at a much lesser volatility. If you know, equities can do 40% in a year and minus 20 the next year. Debt funds typically are will not move in that direction. Even if a debt fund gives 11, 12% in 1 year, the next year the returns are normalizes. And eventually, if you look at across categories, and you can do it on value research or at Zerodha itself, where you can compare long-term return categories of any debt fund category, be it a liquid fund or an income fund or a debt fund or a credit fund. Returns typically range between 7 and 8%. So keep that in mind. That's the objective that you need to have. So point number one, debt funds are not wealth generating products. Point number two is debt funds are only to be used as an alternative to your existing fixed income instruments. And your existing fixed income instruments are many. Indians are over allocated to fixed income. So you have money lying in your savings account, you have money lying in your fixed deposits, you are invested in fixed deposits. A lot of people do PPF, Public Provident Fund. If you're working in a company, you will be subscribed to EPFO, which is the Employee Provident Fund. I would also include endowment insurance that you've bought as an endowment plan. These are all essentially fixed income return instruments. Typically, again, the range will be 5% to 9-10%. You add to that your Sukanya Samriddhi or your Varisht senior citizen. These are all different kind of fixed income instruments. And debt funds can only play as an alternative to. So instead of investing into a 3-year fixed deposit, you might choose to invest in a debt fund for 2 years, 3 years. Instead of leaving your money in the savings account earning you 4%, you can choose to invest into a liquid fund which gives you 5.5%, 6.5%, and linked to where the repo rate is. So it's an alternative. Even for your long-term fixed income allocations, like PPF is long-term, for 10 years, 15 years. Insurance tends to be long-term. Even for that, you can use debt fund category. So remember, it is an alternative and it cannot be the only option. So, and secondly, for Indians, young and old, we have to realize that already we have far too much money in fixed income assets, which is savings account, fixed deposits, provident funds, endowment insurance. And the question really to ask is, do you need more debt exposure at all? Most people will find that they need more equity exposure. They don't need that debt exposure anymore. So the basis of whether you're investing in debt funds should start from that perspective, saying that, do I need to be invested in equities or debt? And in debt, okay, do I need to do savings account, fixed deposit, PPF, endowment insurance, or I can choose the range of debt funds that are available? So that's point number 2. Point number 1 was it's not well generating. That's not should be the focus. Point number 2, it's an alternative. And before you allocate to debt, first figure out whether actually you need more debt investments or you need more equities. Third point of debt funds is, again, this is where people used to get confused more, and now I think they're far more aware of it, is that debt funds are not fixed deposits. Fixed maturity plans, FMPs as they're called, are also not fixed deposits. There is no return assurance, nor there is a return guarantee in a debt fund. So debt funds are openly market linked. And the example is, when you do invest in a fixed deposit, say you buy a 3-year State Bank of India, invest in a State Bank of India fixed deposit. You know that you've invested today, and after the end of the maturity, whether 2 years, 3 years, you will get your principal back and you will get your interest back at the time, at the rate at which you decided while you invest. That doesn't happen in a debt fund. The debt funds are market linked, and nobody needs to be reminded mutual funds are subject to market risk. Is a very open statement. Debt funds, any category of debt funds are subject to that market risk. So there is no assurance that today if you invest you will get X percentage return. In fixed maturity plan, there is that certainty that because it is a closed-ended fund and the fund is exactly buying maturity instruments which mature within that period, you sort of lock into a rate. But of late we've realized even in fixed maturity plans, you might not get back your interest or principal at the same rate. And I'll talk about that aspect later. So that's the third point. Debt funds are not fixed deposits. The returns are not assured, nor are they guaranteed. The fourth point is debt funds carry risks. They are not, just because they are fixed income instruments, which means that you're supposed to get an annual fixed income or interest. That doesn't mean that it doesn't come with risk. So debt funds have risks. I mean, everybody has heard mutual funds are subject to market risks. So debt funds also carry those risks. And broadly speaking, debt funds have four broad kind of risks. The first risk is market risk. Market risk is essentially change in the price of that bond instrument on a given change in yield, in market. So in bond markets, the market interest rate of that bond is called as yield, the bond yield. So, and for your very simplified explanation, shorter the maturity, lower is the market risk, which means if an instrument is a 1-year instrument, on a 50 basis point increase in the bond yield, the price of the bond will fall lesser as compared to a 50 basis point increase in bond yield on a 10-year bond, where the price will fall more. So longer the maturity, higher is the market risk. Shorter the maturity, lower is the market risk. So debt funds across all categories carry market risk. Just to explain to you from a debt fund perspective, a liquid fund which invests only in 91-day instruments, so it invests in very short-term market instruments, the market risk on a liquid fund is therefore much lower on a given change in interest rate. As against, you have a category called long-term gilt funds. So the long-term gilt funds are essentially investing in long-term instruments, 10-year, 15-year. So their change in market, the NAV, will be that much higher if the yields change. So if the bond yields go up, the NAV of a long-term gilt fund will fall by more. Or at the same way, when the yields come down, like you've seen in the last 6 months, the bond yields have reduced from, say, 8% in October 2018 to below 7 as of yesterday. And long-term gilt funds NAV returns, if you see in the last 6 months, would be in double digits because they are investing in long-term instruments, and as yields have fallen, the prices of those bonds have gone up. So debt funds carry market risk. The second risk that debt funds carry is credit risk. Now, credit risk is debt funds invest in government securities and state government securities where the risk of you not getting back the principal is lesser because it's government guarantee, in some sense, a government guarantee where the government will repay your bond. In corporate, where the debt funds and mutual fund managers invest in corporate securities, it has varying degrees of risk profile. Now, the credit risk is one aspect where, so every bond has a credit rating. So two types of credit risks can emerge. Like the company that you invested, say for example, in the recent case, say DHFL, which used to be a AAA rated entity. And as the company fell into some financial trouble, the rating got downgraded from AAA to whatever, about it till about last week, it was about BB or BBB. So the yield on that bond of DHFL, which used to say trade at whatever 8, 9, 10%, increased to 13, 14% because the perception of the market is that I might not be able to receive my interest and principal. Just as an example. So that's credit risk, where the yield on a bond increases because the perception of the company or the financial strength of the company weakens, and it is subject to rating downgrades. That's one case. The second case is if there is a sentiment problem, like that what we saw in September 2018. There was a clear sentiment issue, and yields of everything went up, right? So in September, October, that quarter, even on HDFC, which is like a AAA rated, very high governance, good, very well managed, even yields on their bonds also went up as compared to the government bonds. So that's credit risk. So you might not happen anything to the company, but if liquidity situation tightens or if the sentiment worsens, then the yield on those bonds can increase and give you, and as I said, when yields increase, market price of that bond falls and the NAV of that debt fund can reduce. So that's credit risk. The third is default, which is you invested in a corporate and you do not get your interest and or your principal back, which is what happened with IL&FS. where funds which held IL&FS paper and IL&FS as a company across the group defaulted on their payment obligations. That has a significantly larger impact than credit risk, because in a default, if you're exposed, if the fund is exposed, say 5 to 6, 5, 7, 8% to IL&FS, that amount of holding off on the NAV just completely gets written off to 25% of the value, 50% of the value, or zero if it's a complete default. So debt funds carry those default risks. And in the last 4-5 years, you've seen quite a few instances of default risks which have happened in liquid funds and debt funds. And the fourth risk is liquidity risk, wherein the liquidity in the bond markets sort of evaporates or lessens, and that impacts the ability of the debt fund to redeem their instruments, sell their instruments and make redemptions to the investor. So these are broadly 4 risks, which are not very apparent. They also are there in fixed deposits. Like there is a market risk in the sense that you invest in fixed deposits at 6% and interest rates goes up for the next 3 years, and only after 3 years, when you get back the maturity, are you able to reinvest at a higher yield. So, and fixed deposits can also have default risk, and some fixed income instruments like PPF and PF and endowment insurance are essentially very long term. There's no liquidity. You can't liquidate and sell. So even other instruments have, but it is more apparent and more visible and more in media name in terms of in debt funds. So that was the 4th point. The 5th and the last tenet that we tell investors is that debt funds can also lead you to hold the investment for longer time periods. Purely for tax reasons. So debt funds are taxed as non-equity, which is on a growth plan. The capital gain up to 3-year investments is short-term capital gain, which is at your marginal tax rate. And about 3 years is when you get the benefit of indexing for inflation. So just purely on that basis, if you're comparing, say, fixed deposits to debt funds over a 3-year period, for many investors in many tax brackets, the long-term capital gain tax after indexation in a growth plan may become beneficial on a post-tax basis. So that can itself make you invest in longer term, or you invested in a credit fund which has had a default, or you invested in a long duration gilt fund or dynamic bond fund at a time when interest rate actually, when you invested, it was low, but it went up. And it takes about between 1.5 to 3 years for an interest rate cycle to play out. So you might, just to recover your investment or to get that threshold return that you had in your mind when you invested in a debt fund, you might have to hold for longer periods. So that's the 5th point. I'll just recap. Debt funds are not well generating products. Debt funds are only alternative to your existing fixed income assets, and remember that you might not need debt and you might need more equities. 3rd point is debt funds are not fixed deposits. The returns are not assured. 4th point is debt funds carry various kind of risks: market risk, credit risk, default risk, and liquidity risk. And the 5th point is debt funds may also need you to hold the investment for slightly longer period, either for tax or to just recover your investments. So that's the broad background of how investors should look at debt funds. Now, let me talk about the different categories that are there and why we believe at Quantum that the simpler, the easier, the safer option is I think always going to be a better option, especially for the retail or HNI investor. Institutional investors have better teams and better research and better knowledge of the markets to take advantage of the different aspects of debt funds. But I think the most basic investment that everybody should consider is what is the liquid fund. So the liquid fund, as I told before, invests only in 91-day instrument. So it is essentially a play against keeping your money in savings account. So instead of leaving a lot of money in your bank savings account, which typically gives you 3.5, 4.5%, you can invest in a liquid fund. Liquid funds typically give T+1 liquidity, that if you want money tomorrow, you have to redeem before 3 p.m. today. So it is not like exactly like a savings account where you can write a check. But today there is a innovation in liquid funds called Insta Redemption, which is up to 50,000 rupees you can redeem at a click of at the button. So immediately it gets credited into your account, and then you can use it for your swiping of debit cards or making a payment, doing fund transfers. So liquid funds are essentially an alternative against your savings account. So instead of keeping all your money in savings account, keep some money in liquid. We've also seen investors doing, so everybody wants to time their investments in equities, right? So instead of putting a lump sum amount of money in an equity fund, you can park your lump sum money in a liquid fund and then do two options. One is switch. So whenever the equity market falls or whenever you want to do it, you can switch from the liquid fund into the equity fund, and or do what we call systematic transfer plan. So you can instruct the fund house that on this week or this month, transfer X amount of money from my liquid fund into the equity fund. So instead of doing an SIP, you can do an HTP. So these are the two broad advantages and why you should do a liquid fund. Now keep in mind that what are you trying to do when you're doing this liquid fund? So you would have rather been in a savings account earning 4%. So you're trying to earn slightly more than the savings account and get the convenience of this switch and HTP. So you're not trying to earn too much returns while investing in a liquid fund. The objective of that investment is not to earn very high returns on that surplus cash that you have. And everybody knows we tend to leave a lot more money than we need in a savings account. And in today's financial market and payment systems, you might not need that. So then liquid fund becomes an alternative. But it is not a high return generating. So which is where we say even fund houses and investors should keep the liquid fund, choose liquid funds which prioritize safety and liquidity over returns. So if you're seeing a liquid fund has very high returns, probability is that they are taking higher risk to earn that higher return, because that's what typically higher the risk, higher the return is the normal parlance, right? So in a liquid fund, you don't need to do that. You have to choose funds which have lower market risk, which is anyway there in a liquid fund, and who do not take too much credit risk, because as I said, that's the objective of a liquid fund investment is not that you try to earn too much return. So keep your money choose funds which prioritize safety and liquidity. Then there are many other categories, and SEBI has now categorized debt funds based on maturity. So as I said, shorter the maturity, shorter the risk. So you can actually categorize funds based on maturities. We've been sort of vocal in saying that there needs to be a category on credit also. So there is a credit risk category, but I as an investor, I don't have a choice if I want to invest in a zero credit risk liquid fund or a zero default credit risk income fund. Today, I don't have that option. Only if particular fund houses follow that style and strategy will you get that option, but the regulator is not providing. The regulator is providing you a market risk categorization. So if you do not want any market risk, then you can choose to always be in a liquid fund which has very low market risk. But you can't do the same by choosing a fund which takes very low credit risk or takes zero credit risk by investing all their investments in government securities and treasury bills. Apart from liquid fund, again as an alternative, there are different short-term income funds, fixed maturity plans as a play against fixed deposits. And there's a category of dynamic bond fund. So now instead of you choosing what maturity, exposure and risk that you want, the dynamic bond funds category basically helps you do that. So the fund manager will choose to be long maturity when the interest rates are likely to go down, or short maturity when the interest rates are likely to go up, and try and balance the risk return reward for you. So for somebody who does not want to time and does not have the skill and ability to do it, instead of doing other funds, a dynamic bond fund is ideal. Although at Quantum we've been very vocal in instructing investors that retail investors should understand that, as I said, dynamic bond funds also carry market risk. And if you look at prior to 2013, the the bigger risks in debt funds where people used to be upset about their returns used to come from the bond funds, where yield changes will lead to market price changes, and that used to be the biggest angst of investors, saying that I never knew that a dynamic bond fund can give me negative return in a particular period. And in 2013, people realized that that can happen because yields spiked up on July 2013 by 100, 200, 300 basis points, and investors realized that debt funds can also have negative returns. Post that, we've actually seen a bigger impact on credit, as credit and default risk. So also what happened is, if you look at mutual fund investment allocation, a larger share of money has gone into credit, corporate credit papers as against sovereign. And if you look at the macro background, just as banks have been facing high NPAs over the last 7-8 years, you're seeing some of it play out in the mutual fund. But as they've increased the allocation to corporate credit, they've also faced not in that high manner, but certain pockets of companies and certain pockets of funds have got impacted by credit. So after having looked at those 5 tenets and having to choose, I would still recommend, especially for the retail and the high net worth individual investor, to choose safety, liquidity, and keep your return thresholds lower for whatever is a larger part of your fixed income allocation. Keep that in mind when you're allocating to debt. Some amount of risk you can take, very small percentage of a portfolio if you're okay with it. Otherwise, simple, safe, liquid allocations are the way to go in debt funds. I can take any questions that are there from investors or from the Zerodha team. Yeah.
So what we've done is we've made a list of questions that we thought investors could have while watching this podcast.
Okay.
So let's start off with an asset allocation question. Should someone who's getting started with investing in his 20s think about investing in debt? If not, when should he consider it?
So someone who's in the 20s is purely has to build wealth, right? So the larger part of his allocation he or she's allocation has to be in equities. I don't see a reason why they should be in debt, provided for certain small aspects. Like, the way to plan asset allocation is depending on your risk profile and your job, either your business or your job, how volatile your job or business is. Depending on that, and depending on your risk profile and your family profile, keep 6 months, 12 months, 24 months, 36 months, depending on your risk profile, of money just away into a very, very safe. It could be in cash, it could be in short-term FDs, it could be in liquid funds. Just keep that away and then plan your allocation. So that's the first thing to do. Just keep some emergency cash away from any risks, and don't take any risk on that. And after that, then you plan, okay, this is now, having done that, for some it could be 12 months, for some it could be 24 months, that their job is so volatile that if they get laid off, then it might take them 8 months, 12 months to get back a job. Or if they already have EMIs, either house EMIs, or they have car EMIs, or today they have consumer durables, vacation EMIs, a whole lot. Keep that money away and then plan your allocation. And then if you're in the 20s, you should just choose to have a very, very large allocation to equities.
So one question that would probably follow in such a scenario when talking about risk would be, it seems like IL&FS caused a domino effect in the markets, and
Mm.
we are seeing a wave of defaults and downgrades right now. So just a couple of days earlier, investors lost as much as 50% in some debt funds.
Mhm.
What should investors do in such situations?
You're saying if they've already invested in a fund which has
Yeah,
lost?
yeah. So yeah, they've already invested in the fund. They've lost 50% of the corpus, and they were assuming it to be safe, somewhat risky, but then predominantly safe. So what should they do in
Yeah,
such situations?
that is a tough
Mhm.
call. I mean, in the sense that uh, see, mutual fund managers can make mistakes. It's not that every single instrument, every single investment that they make uh, uh, has to go right. It doesn't go right in equities.
Right,
It doesn't go right in debt also. So, we cannot demonize investment managers' mistakes. I mean, that's
right,
the only thing to note is uh, whether that fund investment objective was suitable for the risks that that the funds had taken. That's a aspect which I think, as you whenever you see events like this, issues like this, uh, of course mutual fund investments will sort of get fine tuned, investment objective will get fine tuned, and it was no different when I used to manage the quantum liquid fund prior to 2013, and as I saw the various risks getting evolved in the system, and also marrying it with the investment objective of what a liquid fund is, the quantum liquid fund has sort of reduced the exposure. I think that will happen across categories. Also, investors will also get more aware. Uh, they can't really say that if they've invested in a credit risk fund, that there was, they can't be shocked when a credit risk fund has a issue. There is a certain amount of shock when a short-term income fund or a normal bond fund has these issues. But
right,
again, this is it's the macro environment that you also have to see in the backdrop. And so once you already invested today, if you see the entire mutual fund industry is what we call as mark to market. Apart from that 30 days, up to 30 days is amortized. So any credit event or a default, both, or and any market risk is straight away transferred into the NAV. So if a company has defaulted, that amount of proportion of your assets is completely marked down.
right,
And uh, the problem that we're seeing is so funds which own IL&FS or which own some other companies, they've stopped seeing inflows because the investors are worried that I'll also get a hit, and or existing investors have sort of reduced. And the this is a larger problem in the Indian corporate bond market. It's not as liquid. It's very similar to your small cap, mid cap market. Whenever there is a issue of sentiment or liquidity tightness, the liquidity in the bond market is fairly non-existent at times. So there is very little. There's little exit, and India still does not have a very well-functioning or highly developed distressed fund market
right.
where distressed funds can buy out from the mutual funds balance sheet certain entities which are in trouble or out of trouble. So investors who are already invested, it's a tough call. Either they they have to take that call and they want to book the losses, or wait and hold and see whether the mutual fund managers are able to recover that money. Frankly, it's a tough call.
Right. One of the questions that you've already sort of addressed, but just to reiterate, would be nowadays there's um, a common piece of advice floating around the internet for
Mhm.
investors to avoid duration and asking them to stick to liquid or short-term
Mhm.
funds.
Yes.
Uh, is there any validity to this advice?
Yeah, there is validity to that advice. As I said, if you look at prior to 2013, the major angst of retail investors was that they realized that a bond fund or a dynamic bond fund or a gilt fund would give them assured returns and a stable income. And at times, market interest rates have been volatile. So, the NAV of the bond fund changes. So, I don't agree that only credit funds and income funds which have credit allocations are risky. Duration funds are riskier in terms of market risks also. So so just go back to the 5 tenet. Like, why do you want that allocation? And if you want that allocation in a duration fund also, your holding periods have to be longer. You cannot invest for a 6-month period unless you can time it well and you understand repo rates and RBI monetary policy and all those things. Unless you can do that, you will have to play out a full cycle, 3 years and above, for that 7 to 8% average returns that I spoke about at the start, for it to get realized. Because at some time you might actually get 11-12% as you see the yield funds recently, and the next year your returns would be 3-4-5%. But so over a 3-year rolling return basis, duration funds or dynamic bond funds tend to sort of average in that 7 to 8% return. So you will have to stay invested. So if you do not want to lock in yourself and stay invested for that long, then the best option is just to be in liquid. And I don't ask people to hold me to this, but I just use a rule of thumb, very, 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 very broad rule of thumb, that when interest rates are at like 6% and are likely to increase, right? And you would know that from market commentary, RBI is likely to hike rates. When interest is likely to go up, an investor is better off in a liquid fund. Because as you said, liquid fund is invest in short-term instrument. So if, say, the interest is move up from 6 to 7%, a liquid fund can reprice its portfolio yield with very low market risks. And the portfolio yield keeps on increasing between 6 and 7%. As against an FD, like you invest in a 1-year FD at 6%, and only 1 year later can you reprice that instrument if the rates are gone. So when rates are rising, you're better off in a liquid fund. And purely based on a historical analysis, when interest rates go above 8.5%, like the repo rate goes at 8% and bond yields are at 8.5% and above, is when the time is for you to lock in your debt investments. So either you do long-term fixed deposits, 3-year, 5-year, or that's the time when you can invest in a bond fund. So this is like very pure benchmark, because over a long 3-year cycle, interest rates do not sustain for too long over that 8.5-9%, and eventually comes down. So you sort of benefit from a higher yield even initially, and then some capital gains. But this is very generic. This is very very broad based.
Right.
But this is the benchmark to say. So between 6 and 7, and it is rising, you're better off in liquid, so that you avoid that market risk component. And of course, the safety, low credit, highly liquid goes without saying for most investors.
So another question, exploring a different sort of risk, mutual funds lending to promoters, that has come under fire after certain FMPs decided to delay and roll over the majority. Should mutual funds be in the lending business? How should investors navigate this?
No, I mean, mutual funds are in lending business in the sense that they just invest in bonds, and the bonds are borrowed by companies for their business. So any investment that a debt mutual fund makes, including buying a government bond, is basically lending to the government.
Right.
Or buying a corporate bond is lending to the corporates.
Right.
Now, in the corporate, you can have different structures. One could be just pure balance sheet lending, which is a NCD, a non-convertible debenture or a bond issued by a corporate, and the debt mutual fund sort of buys that in their portfolio. The other could be securitized products, where certain pools of assets of a corporate or of a financing company or a bank is securitized, and many diversified investors own a diversified pool of assets. And of course, what you said, loan against shares. So that's just another way of lending or advancing credit or buying a bond,
right.
Which is promoter funding. It used to be a fairly popular NBFC product, but over the last 5-10 years, we've seen mutual funds also do it. the good aspect of loan against shares is that it's a very liquid product, right? With the collateral is equity shares of I'm assuming highly of good companies. So when there is a sign of trouble, you can essentially sell the equity asset and it has a collateral. The problem is when there is multiple loan against shares, and this again comes back to the same liquidity thing, right? So if the promoter is very heavily pledged and there are just too many people holding the collateral as against the underlying liquidity of that company, and that's when it could be an issue, right? So again, this is a very investment specific and mutual fund specific investment. If they can do it with all the risks and all the risk management that goes along, fine. If they're not, we've seen some impact of it. So difficult to comment whether they should do or not.
Right.
It really depends on each fund house, fund manager, and that scheme's objective.
Correct. So a question somebody who's nearing his retirement might have, they want to move from equity to debt. What advice would you have for them?
So that you have to do it. Now it depends on whether you want to do it at 55, 60. People tend to live longer today.
Right.
So, and cost of living doesn't go down after retirement. So, you have to balance that you still might need some amount of equity exposure also. Apart from that, of course, it is better to move into a fixed income asset. Possibly tax bracket and taxability for many investors might also be lower after retirement. So then debt on a post-tax basis gets better, both FDs as well as debt funds. There is something called systematic withdrawal plans today, which you can put into force, where every month you say that I want X amount of my equity corpus to move into a debt fund. And again, those same 5 tenets apply when you do any allocation, whether it's for retirement or for saving or for surplus money or for contingency money. So you just follow those 5 tenets that are laid down at the start, and you can build your retirement corpus.
So the next question that we have is about the market structure. You have been in the debt markets for about a decade now. More than a decade now, and the markets have evolved, right? So where are we vis-a-vis the other emerging markets, and what has to change to make the debt markets more retail friendly in India?
So if you look at the size of the Indian bond market, it's fairly large. I think in the emerging market, we are third largest, or in Asia, we are third largest after China and Korea. But India is still largely a sovereign bond market. Last I saw, so India's bond market size is about $1.5 trillion, and about 60-65% of that will be government bonds, central government bonds, state government bonds, treasury bills, and state guarantees, and that segment. In the corporate segment also, a fairly large chunk of the corporate bond market is also dominated by the PSUs, public sector undertakings. Entities like NABARD, SIDBI, Indian Railway Finance Corporation, NTPC, Power Grid, Power Finance, entities which are, or public sector banks also for that matter, entities which are 50% or more owned by the government. And then the rest is the private corporate sector. And if you look at one big trend that has happened is insurance companies and mutual funds both have grown in assets, both have grown in debt AUMs also, and they've been reasonably large investors in the corporate bond market, which is very, very good. Underlying liquidity has still not picked up, but that's not an India issue. I mean, globally, barring the US markets, the corporate bond market tends to be sort of a buy and hold, and the liquidity is large only for the AAA or the AAA PSU. And for lower rated, it tends to be buy and hold, which is which is across. But there's been a significant development. The size of the bond market itself has increased. The number of private placement and public issues of corporate bonds has increased. SEBI has done a tremendous amount of work in disclosures, in transparency, in trading details being online available. The bond issuances are online. It's an electronic system, both for government bond markets and now for corporate bond markets. Settlement systems have become far more predictable. There's reporting of almost all transactions. Mutual funds have to even report inter-scheme transactions.
Right.
So there is a lot of transparency, and it is only going to increase. And so these credit events and credit risks that we see, eventually these things tend to be good for the longer term development of the bond market, because practices get better, investor appetite, sentiment, the behavior of the investor, having seen a case of default, changes for the better. They know what to expect, and these are all very, very overall are very, very good. So SEBI now also mandate, if you're a large corporate, some X percentage of your borrowing has to be from the bond market.
Right.
So the disintermediation from the bank loan market to bond market is also continuing. You have many private sector banks who have a fairly large corporate bond book, and that's only going to increase. So the development is happening. Retail participation is purely better off through mutual funds, because mutual funds have the ability to research, invest, and diversify your allocation. We keep hearing a lot of investments in retail NCDs, and that's fine. And you still have to do your research before investing in a retail NCD, because as I said, these are not assured, these are not fixed. Even they have subjected to market risk, credit risk, and default risk. So from that perspective, you're better off in a debt fund, because of that ability of diversification and the research and investment skills that a fund manager possesses.
So I think follow up to that, and you've touched this briefly, would be in case somebody wants to take exposure to credit risk, should they invest in credit risk funds? Does it make sense for retail investors?
If they want to specifically take exposure to credit, they should choose a credit risk fund, because so their objective is clear. They want to try and earn that slightly higher return and yield that comes from investing in companies which are lower credit rated.
Right.
And some mutual funds have done very, very well in that segment. But no one should make it a very high percentage of the allocation, is what I'm.
I suppose the question is the risk reward trade-off beneficial to the retail investors in such funds?
If you see purely returns of the category, I don't think so. It hasn't given way higher returns than a normal low credit risk bond fund. Because I think there is far too much money chasing that segment, or at least till about 6 months back. Much more AUM from mutual funds were chasing that segment, and there are the end number of corporate issuers, but only a select few whom you want to invest. Because I said, credit investments tends to be hold to maturity. There is very little chance of you being able to sell out and exit the corporate. So I think that's too much money. So pricing of lower rated papers were not as lucrative as maybe they are right now. And the second aspect is the same liquidity aspect. I think, as I said, the underlying liquidity and the amount of AUM that the credit funds or the credit risk strategies manage is at complete odds. So in scenarios like this, when there is stress or investors wants to exit, you are feeling that stress in the bond market, where the underlying liquidity is just not there. So risk return from that perspective has the excess returns that you're earning from a credit fund.
Yeah.
I don't think commensurates for the risks. Maybe the yields, the
Right.
returns have to be higher
Right.
for just but again, you can do it very low allocation of your portfolio should go.
Right. I think one final question you briefly mentioned about 2013, which was, I think, the taper tantrum episode where the Fed was with coming out with the quantitative easing, the second
Correct.
one. And could you briefly explain what happened and sort of reiterate that risk?
Yeah. So at that time, debt mutual funds didn't have too much credit exposure. The exposure that they had was government bonds and government securities and AAA PSUs. And what happened in 2013, and it was the impact was happening over the last 1 year, is on July 16th, if I remember correctly, 2013, the Reserve Bank of India increased interest rates by 300 basis points on one single day. And that was essentially to stem the depreciation in the INR that was happening.
Yeah.
So that was a real shock. We haven't seen anything like that in our history or our in my history. Where I remember Quantum Liquid Fund had a negative return on that for that particular day, because 300 basis points increase in market, and Quantum Liquid Fund was a fully mark-to-market product at that time.
Right.
And so short-term interest rates went up by 200, 300 basis points, which led to negative returns for almost practically a lot of liquid funds that day. And long-term interest rates also went up. I think the 10-year on that day was about 7.5 or something like that, and went up to 8.25. And eventually by August 2013, the 10-year bond yield was at 9% plus.
Right.
So that was like a 150 basis points increase in interest rates over a very short period of time. And almost every bond fund category was in negative territory. And that was purely market risk. We didn't see any major credit event during that time. This is purely interest rates increasing, leading to a fall in bond prices. So, duration funds did also have risk. This is the takeaway from that. And since that, what has happened is, at least from a monetary policy perspective, it's become far more stable. India now follows a flexible inflation targeting range. It also tends to have positive real rates, and that has a very big impact on the market, because the inflation risk, which is the biggest risk in bonds, is priced by the RBI for the market, and the bond market then essentially only has to price liquidity, spread, credit, and default. So that's a big development that happened post that fiasco. So we believe over the long term, if they continue to follow this inflation targeting, real rate targeting framework, interest rates in India will be in a narrower band. We do not expect, although the repo rate was cut below 6%, but we do not expect the repo rate to sustain below 6 for a long period of time. As against, we do not expect the repo rate to go and sustain above 8% for a long period of time. So what was 4.5 and 9.5 in the earlier scenarios should move to 6 to 8 in a very narrower band, if you want to take a narrow band. So that's good for investors. Volatility of interest rate should be lesser.
Thank you, Arvind. I think a lot of takeaways from this episode, not just for all the investors, for also the team here at Zerodha. And we're very appreciative of your time, the time that you've given everyone. I hope that we can do something like this again.
Sure. I'll be happy to do it.
Thank you.
Thank you.